Welcome to this session on changes to PCAOB auditing standards brought about in the recent amendments from PCAOB release number 2022-002, Planning and Supervision of Audits Involving Other Auditors and Dividing Responsibility for the Audit with Another Accounting Firm, adopted by the board on June 21st, 2022. My name is Andrew Cleve, and I'm an assistant in the Office of the Chief Auditor at the PCAOB and was part of the project team that worked on the amendments. The amendments strengthen the requirements and responsibilities that apply to auditors who plan and perform audits that involve other accounting firms and individual accountants by increasing the lead auditor's involvement in and evaluation of the work of other auditors and aligning the applicable requirements with existing PCAOB risk-based supervisory standards. Given the intent of this training to provide an overview, we will not be discussing all of the nuances of the amendments, only those things that are likely to have the most significant impact for most auditors. As a result, I encourage participants to read the adopting release I mentioned earlier in order to gain a more complete understanding of the amendments. Before we get started, I'll just state our standard disclaimer that the views expressed are those of the speaker and do not necessarily reflect the views of the board as a whole, any individual board members, or other staff. In part one of our session, we will start off with the definitions created as part of the amendments. Understanding the definitions is critical to correct application of the amendments. Next, we'll talk about planning, which we'll discuss among other items, determining who is the lead auditor in an engagement that involves other auditors or referred to auditors, and planning considerations of the lead auditor when other auditors are involved. In part two of our session, supervision will be our third topic, where we will be discussing the new procedures that the lead auditor should perform in order to appropriately supervise other auditors. Special considerations around multi-tiered audits, including what a multi-tier audit is under the amendments, will be next, followed by the divided responsibility model when a lead auditor in its audit report makes reference to the audit report of another accounting firm. And finally, we'll talk about a few certain other amendments. Note that the amendments are effective for audits of fiscal years ending on or after December 15th, 2024. Let's briefly talk about some of the broader concepts that guided the amendments, including the various models that exist under the extant standards. Firstly, the extant standards allow for involvement of other audit firms under three models. The first is using the work and report of another accounting firm 2 in this slide, under AS 1205. The second is supervising another accounting firm under AS 1201, again, accounting firm 2 in the slide. And the third is dividing responsibility for the audit with a referred to auditor, in this example, accounting firm 3. Under the amendments, the approach under AS 1205 to assume responsibility for the work of another accounting firm when using work and reports is no longer available, as that standard has been rescinded in its entirety by the amendments. And as a result, we have the modified version of this figure as follows. You can see AS 1205 has been removed from the box at the top left, as the board has removed the option of the lead auditor to assume responsibility for work and reports of an other auditor. And now the lead auditor may only either supervise an other auditor under AS 1201 or divide responsibility for the audit with and refer to the work of a referred to auditor under AS 1206. It's important to note that our research in this area reflects that a very small number of audits are performed under the divided responsibility model, where the lead auditor makes reference to the report of another accounting firm. It's tracked for the last several years at around 40 per year. And as a result of the amendments, the large majority of audits that involve another accounting firm will now fall under the supervision approach of AS 1201. And lastly, before we move on from this illustration, we'll highlight one key element that the two models differ on with respect to involvement of the lead auditor. Under the amendments, accounting firm 2 is supervised by accounting firm 1, while accounting firm 3 is not supervised. These differing relationships drive the amendments to the lead auditor's supervision responsibilities, which we'll talk about in a later section. Next, we'll talk about the four definitions that are included in the amendments, which are engagement team, lead auditor, other auditor, and referred to auditor. These definitions were created in order to operationalize the amendments and were updated throughout the standards where existing requirements were intended to employ the new definitions. Let's talk about engagement team next. Before we start discussing the nuances of the definition of engagement team, we'll share the actual definition in the amendments, specifically paragraph A3 of Appendix A to AS 2101. At first glance, there is a lot to the definition, and you will notice that the definition consists of two main components. The first, A, identifies the individuals and entities that constitute the engagement team. Meanwhile, the second, B, specifies those individuals and entities that are excluded from the definition. Who will end up being part of the engagement team will require careful application of the provisions in the definition and may end up being determined by what involvement an individual has on an engagement team. Now let's talk about some impacts of the new definition of engagement team and give some examples of people and entities included and excluded. The term engagement team is frequently used throughout the existing standards, somewhere in excess of 100 instances. And while that term is used frequently, it had not previously been defined. As a result of the definition of engagement team in the amendments, there are several uses of the term in the existing standards that will now utilize this definition when applying those requirements. For example, AS 1015, AS 1210, AS 1215, AS 1220, AS 1301, AS 2110, AS 2201, AS 2410, AS 2810, AS 3101, AS 4105, AS 6115, as well as AT1 and AT2. The engagement team includes partners and professional staff employed or engaged by the lead auditor to perform audit procedures on the audit, or assist the engagement partner in fulfilling their planning or supervisory responsibilities. And in our diagram from earlier, that would include personnel at accounting firm 1 and at accounting firm 2. Also included are employed specialists who assist in obtaining or evaluating audit evidence, but the definition excludes EQRs, personnel of referred to auditors, and engaged specialists. Under the amendments, the lead auditor, which we'll talk about next, is responsible for supervision of the engagement team. Because of the clarification provided by the new definition, the responsibility of the lead auditor for planning and supervising the work of individuals outside of their firm has been extended to situations previously governed by AS 1205. And as such, it is critical for the engagement partner to understand who is in and who is out of that definition. On the slide, we have some of the examples provided in the adopting release to illustrate the application of that term. For instance, part of the engagement team includes the engagement partner, personnel from the engagement partner's firm who perform audit procedures, personnel of accounting firms outside the engagement partner's firm who perform audit procedures, and national office or centralized group personnel who perform audit procedures or assist in planning or supervising the audit. Who is not part of the engagement team includes auditor engaged specialists, engagement quality reviewer, the Appendix K or filing reviewer, personnel of a referred to auditor, third party service organization auditors, and individuals employed or engaged by the company being audited, for example, internal auditors or company specialists. The next definition from the amendments is lead auditor, which is displayed here from paragraph A4 of Appendix A of AS 2101. You may recall from the previous slide that the lead auditor is responsible for supervision of the engagement team, which we just discussed. Because of that, determining who meets the definition of lead auditor will be critical in understanding who is responsible for that supervision. As with the definition of engagement team, careful application of the definition of lead auditor will be required to understand who has the responsibility under the amendments to supervise the engagement team appropriately. Let's talk now about some of this. I'll say it again because it bears repeating that the lead auditor is responsible for carrying out proper planning and supervision under the amendments. But who is the lead auditor? You may have noticed from the previous slide, the new definition includes both the firm issuing the auditor's report and the engagement partner, as well as other personnel from that firm who assist the engagement partner in planning or supervisory responsibilities. In our chart from earlier, accounting firm 1 is the representation of lead auditor, but also the engagement partner and personnel that assist that partner in planning and supervision. Additionally, individuals from outside accounting firm 1 and who work under the accounting firm 1's direction and control and function as accounting firm 1's employees would also be considered part of the lead auditor. Lead auditor is replacing the existing term principal auditor, which was used in several standards and previously explained within AS 1205, which was noted earlier as being rescinded in its entirety. As AS 1205 only applies to some audits that involve multiple firms, specifically those where the other auditor audits the financial statements of one or more of the company's subsidiaries, divisions, branches, components, or investments, and issues a report. Because of this, there may be changes for audits to which AS 1205 does not apply, where the other auditors are supervised by the lead auditor under AS 1201. This includes the consideration in all audits under the amendments around who may actually serve as the lead auditor, which we'll discuss in the planning section. Also included in the definition on the previous slide and noted on this slide is the consideration that individuals who work under the direction and control of the firm issuing the auditor's report and function as that firm's employees and otherwise meet the other elements of that definition are included within the definition of lead auditor. This includes, for example, secondees. This means that an individual does not necessarily need to be a partner, shareholder, or employee of the lead auditor firm in order to be included within the definition of lead auditor. The amendments include in footnote 5 to paragraph A4, which you may have seen on the previous slide, requirements for what is considered a secondment. These are consistent with Form AP staff guidance issued in December 2021 and excludes as a factor the physical location of the employee. And lastly, an important observation here is that not all external individuals working under the direction and control of the firm issuing the auditor's report fall under the definition of lead auditor. Only specific individuals that are assisting the engagement partner with planning or supervisory responsibilities are considered part of the lead auditor. Other auditor and referred to auditor, represented as accounting firms 2 and 3 from our previous diagram, establish the other defined roles within audits that involve multiple accounting firms. But who are they and what roles do they play? The definitions of other auditor and referred to auditor from the rule text are on this slide. The differences in the definitions reflect the overarching concept that other auditors are considered to be part of the engagement team and are therefore supervised by the lead auditor, while the referred to auditors are not part of the engagement team. Referred to auditor is more succinctly defined and reflects a firm that is referred to in the lead auditor's report, also referred to under the existing and amended requirements as a divided responsibility engagement. Referred to auditors are responsible for planning and performing their audit of a business unit to support their standalone audit report on such. Referred to auditors are not part of the engagement team, and engagements that involve one or more referred to auditors are the subject of the new AS 1206. Other auditors are part of the engagement team. Because of this, the lead auditor has responsibility for planning and supervising their work, meaning that the scope of the other auditor's work is determined by the lead auditor. The definition of other auditor includes members of the engagement team except those who are part of the lead auditor, and that includes those of personnel who function as the lead auditor firm's employees. The term other auditor also includes the public accounting firm these engagement team members are personnel of. Now that we've established the definitions from the amendments, we can start talking about the requirements that apply under the amendments. Taking things in a logical audit workflow order, let's talk about planning first. As discussed in the release and in paragraph 0.05 of AS 2101, planning is not a discrete phase of the audit. This consideration additionally applies to the amendments we will discuss in this section. Therefore, the engagement partner is expected to revisit their determinations for things like whether they can serve as the lead auditor, which we'll discuss next as circumstances change. When using the work and reports of another auditor, existing AS 1205 requires the principal auditor to consider whether their participation in the audit is sufficient for them to serve as the principal auditor. There are no similar considerations under the existing AS 1201 supervision model. However, under the amendments to AS 2101, in all audits, the engagement partner is required to determine whether their participation is sufficient to serve as the lead auditor. The engagement partner's sufficiency determination should take into account 3 considerations in combination. These are the importance, quantitatively and qualitatively, of locations or business units for which the engagement partner's firm performs audit procedures in relation to the financial statements as a whole. The risks of material misstatement associated with portions of the financial statements for which the engagement partner's firm performs audit procedures in comparison to portions performed by other auditors or referred to auditors, and the extent of the engagement partner's firm's supervision of other auditors' work on portions of the financial statements for which they performed audit procedures. While the first 2 apply to other auditors and referred to auditors, the extent of supervision does not apply to referred to auditors, as they are not supervised like other auditors. On another note, the extent of supervision has special considerations when applied to a multi-tiered audit. Only directly supervised other auditors may be considered, which we'll discuss in part 2. You'll notice that there's a bullet on the slide regarding divided responsibility audits and a threshold of participation being included in the amendments of 50%. This threshold is in addition to the importance and risk considerations we just discussed applicable to divided responsibility audits, and is similar to SEC staff guidance included in the Division of Corporation Finance's Financial Reporting Manual and preserves historical practice within the industry. The threshold itself, while having an explicit percentage, is intended to be a presumption, meaning that it can be overcome with appropriate consideration and documentation of why the engagement partner's firm's involvement is sufficient to serve as the lead auditor. The amendments require the lead auditor to perform audit procedures to a meaningful extent, and supervision of other auditors' work isn't, on its own, sufficient to serve as the lead auditor. This means that the engagement partner's firm cannot solely supervise other auditors in order to have sufficient participation. And lastly, the standard requires that in an integrated audit, only the lead auditor for the financial statements can be the lead auditor for ICFR. This means the lead auditor of the financial statements must also participate sufficiently to be the lead auditor for ICFR. We'll take a look at a few examples to illustrate sufficiency of participation. In this first example, the company is a multinational headquartered in country A, where the global headquarters is located and includes the offices of the CEO, CFO, and controller, who make all of the key financial and reporting decisions, including the significant management judgments necessary to prepare the company's financial statements, such as selection of accounting policies and important asset and liability valuations. Operations are spread roughly evenly among many business units in other countries. The headquarters staff in country A are responsible for consolidation, preparation of financial statements, and significant accounting conclusions. Accounting firm A in country A is engaged by the company to audit the financial statements and issue a report. Firm A plans to test the consolidation and evaluate presentation of the company's financial statements, including the disclosures, and perform other procedures to evaluate audit results. Firm A will utilize other accounting firms to audit the business units in other countries, but Firm A plans to perform audit procedures, including risk assessment of the financial statements as a whole, which also includes determining which business units are selected for audit procedures. Firm A also plans to perform audit procedures over the business units in country A. Firm A plans to supervise the work of other firms under PCAOB auditing standards, their extent of supervision commensurate with, among other things, the risk of material misstatement associated with the business unit. In example 1 under the amendments, Firm A's involvement would likely constitute sufficient participation in order to serve as the lead auditor, as the procedures relate to high-risk areas and important company locations, and the firm plans to supervise the other auditors at an extent necessary so as to be commensurate with the risks of material misstatement. Let's look at our second example. We have a similar company background for example 1, except that the company utilizes 3 shared service centers to process most of the transactions for the company as a whole. The audit background is also similar, but has some differences for changes in the company. Like example 1, Firm A will utilize other accounting firms to audit the company's business units in other countries that were selected for testing by Firm A and will supervise those other auditors. Different for this example is that Firm A plans to work with those other auditors to design procedures to evaluate the results of work performed at the shared service centers, and Firm A made the determination that audit procedures should be performed with respect to all 3 shared service centers by other auditors in those countries. Firm A also plans to coordinate the audit response with impacted other auditors to any audit issues or previously unidentified risks related to the shared service center. In this example, Firm A's involvement would also likely constitute sufficient participation in order to serve as the lead auditor. Similar to our first example, the procedures Firm A plans to perform relate to high-risk areas and important locations, but also includes designing and evaluating other firms' work at these shared service centers, as well as supervision of the other auditors' work at business units. Our third example changes the fact pattern quite a bit. In this one, the company is domiciled in country A, where some of the senior executives and most directors are based. However, substantially all of the operations take place in country B, as well as all financial reporting and back office functions. Lastly, executives in company B make substantially all of the day-to-day operating, accounting, and financial reporting decisions. With regards to the audit, country A requires the auditor of the financial statements to be located within country A. As a result, the company hires firm A to perform an audit and report on the financial statements. Accounting firm B, located in country B, will provide documentation to firm A describing firm B's work and findings. Firm A plans to use firm B as an other auditor to perform audit procedures on the operations in country B that constitute substantially all of the audit procedures on the financial statements. Firm A will use Firm B's audit documentation as the primary basis for its opinion on the financial statements and issuance of its audit report. Under the amendments, the involvement of Firm A would not be sufficient to serve as the lead auditor because substantially all of the audit procedures on the financial statements are performed by another auditor with minimal involvement from Firm A. The amendments are not intended to provide a way for an accounting firm to take responsibility for the work of another auditor that has essentially audited a company's financial statements in their entirety. In our last example of sufficiency of participation, we have a modification of the background from example 3 with the same company background. However, Firm A has taken a different approach. Firm A plans to take the lead on performing risk assessment procedures directed to identifying and assessing risks of material misstatement to the company's financial statements as a whole, testing the consolidation, evaluating the financial statement presentation, including disclosures, and performing other procedures to evaluate audit results. Firm A also plans to work with Firm B to design procedures and evaluate the results of Firm B's work with a focus on areas of higher risk of material misstatement, particularly those requiring judgment. If an audit issue or previously unidentified risk of material misstatement is identified, Firm A intends to coordinate an audit response with Firm B and evaluate the outcome of that response. And finally, Firm A plans to supervise the work of Firm B in other areas of the audit to an appropriate extent. Under the amendments, Firm A's involvement would likely constitute sufficient participation to serve as the lead auditor. Although substantially all of the company's operations and financial reporting functions are in another country, Firm A will perform audit procedures in high-risk areas related to the financial statement and will be involved in designing and evaluating auditor work in other high-risk areas, as well as supervising Firm B. Let's move on to some of the other planning considerations, starting with compliance with independence and ethics requirements. Once an audit firm has determined that it may serve as the lead auditor, the first planning aspect of involving other auditors is to perform specific audit procedures regarding other auditors' compliance with independence and ethics requirements. Unlike the existing standard, which only states that the auditor should perform activities to determine compliance with independence and ethics requirements, the amended standard describes specific procedures that the lead auditor should perform in order to determine the engagement's compliance with independence and ethics requirements. Included within these procedures, the lead auditor is responsible for obtaining an understanding of an other auditor's knowledge of and experience in applying independence and ethics requirements, attaining from other auditors a written affirmation as to whether the other auditor has policies and procedures that provide reasonable assurance to maintain compliance with independence and ethics requirements, a written description of all relationships between the other auditor and the audit client, and a written affirmation as to whether the other auditor is in compliance with the requirements with respect to the audit client. The lead auditor should also inform the other auditor of changes in circumstances that affect compliance with independence and ethics requirements and are relevant to the other auditor, and request updated affirmations and descriptions. Lastly, if the lead auditor becomes aware of information that contradicts any of the affirmations or descriptions provided by another auditor, the lead auditor should investigate the circumstances and consider the reliability of those affirmations and descriptions. Let's talk quickly about registration status of other auditors. PCAOB Rule 2100 requires a public accounting firm to be registered with the PCAOB if it prepares or issues any audit report with respect to an issuer, broker, or dealer, or plays a substantial role with preparation or furnishing of an audit report with respect to any issuer, broker, or dealer. However, the existing standards do not include explicit requirements within the auditing standards for the assessment to be made. The amendments provide that the lead auditor may use the work of a firm that plays a substantial role only if that firm is registered with the PCAOB. The amendments are intended to promote compliance with existing PCAOB Rule 2100, the board's rule on registration requirements for accounting firms, Given examples we have seen in the past when unregistered firms play a substantial role in the audit but were not registered with the PCAOB. The amendments provide that if an other auditor will play or has played a substantial role in the audit, the lead auditor may use the firm's work only if the firm is registered with the PCAOB. And because we discussed earlier that planning is not a discrete phase of the audit, the determination of whether a firm plays a substantial role is made throughout the audit. For example, if a firm's involvement is planned at a non-substantial role level, but subsequently facts change that increase their involvement to meet the definition of play a substantial role, the lead auditor may only use that work to support their opinion if that firm is registered. Also note that the new AS 1206 on divided responsibility audits includes a similar requirement for referred to auditors under the divided responsibility model. Let's talk next about assessing KSA of and communications with other auditors. Under existing requirements in AS 1201, supervision by the engagement partner and those who assist the engagement partner in supervising the audit should take into account the knowledge, skill, and ability of engagement team members. This is clearly an easier assessment to make for an engagement team when everyone works for the same firm. The amendments enhance those existing requirements by creating specific requirements of the lead auditor to assess the KSA of other auditors, including for other auditor engagement team members who assist the lead auditor with planning and supervision, obtaining an understanding of their KSA, including experience in the industry and knowledge of the relevant financial reporting framework, PCAOB standards and rules, and SEC rules and regulations, as well as their experience in applying them. For all other auditor engagement team members, a written affirmation from the other auditor firm that its engagement team members possess the KSA to perform their assigned tasks. The lead auditor is also required to determine that they are able to communicate with the other auditor and gain access to their documentation. This requirement is intended to help the lead auditor identify and address any communication or access issues early in the audit and is based on existing provisions and other PCAOB auditing standards. One last item with respect to planning is a retained requirement related to multi-location engagements where other auditors or referred to auditors are involved. This specifies that the lead auditor determines the locations or business units where audit procedures are to be performed. And that concludes part one of the presentation on some of the changes coming about as a result of the rulemaking on other auditors. I'd just like to say thanks for listening, and please tune in for part two of the session. Also, for more information on the amendments and the rationale for the changes, please see the adopting release from June 2022, which is PCAOB release number 2022-002. Thank you.